All right, let's jump in. Three things today. First, another major regional bank deal and what it tells us about where we are in the cycle. Second, private credit. It's back in the headlines, and I want to walk through how we're thinking about it as bank investors. And then we will wrap up with a quick update on fundamentals as we move here through the first quarter.
Before we start, a quick disclosure. Joe Finnick, Kevin Swanson are employees of GenOpp Capital Management, investment advisor that maintains exempt reporting status in the state of Indiana. This podcast represents the views, beliefs, and opinions of GenOpp members and does not assert to be complete. The information presented in this podcast is provided to you as of the dates indicated, and opinions presented may change. You should not rely on this podcast as a basis upon which to make an investment decision. This podcast is not intended to provide and should not be relied upon for tax, legal, accounting, or investment advice. GenOpp's clients or its members may hold or recommend to GenOpp's private fund clients the purchase or sale of securities of companies discussed in episodes of this podcast.
Okay, let's start with M&A. Since our last episode, another large regional bank M&A announcement. Feels like old news at this point, given everything that's happened since. But Webster has agreed to be acquired by Santander. Full disclosure, we owned Webster in our fund, and takeout potential was an important component of our thesis. The buyer may have surprised some people. It surprised us. The fact that Webster was in play did not. And more importantly, this deal is confirmation that the regional bank M&A thesis is playing out. We've been very specific about this cohort. There are only 25 banks in the country over 50 billion in assets. That's a very small universe. For most of the past nearly 20 years, that group was effectively frozen out of transformational M&A. The regulatory environment simply wasn't supportive of large regional bank combinations. That's changed. So for the first time in a long time, regulators are open to these deals. And so when you combine that unlocking of the regulatory aspect of it with the fact that there were only 25 scaled institutions to begin with, and generally cleaner deal math at that size because of balance sheet interest rate marks and other things, you get scarcity. Now, if you layer in Webster specifically, Webster had scarcity value nationally as one of those 25 large regional banks, but it also had scarcity value regionally. In the Northeast, which is not the fastest growing part of the country, obviously, there were only about 5 scaled banks left in that size range. So now there are 4. So even in a less demographically attractive market, scale becomes strategic because there simply aren't many platforms left to acquire. So that's sort of a microcosm of why we referred to regional banks more broadly as the scarcity play of this cycle from an M&A standpoint. We frame the group as hunters and hunted, and each of these regionals is in either one bucket or the other. And this dynamic continues to unfold. 7 of these larger regionals, roughly a quarter of the total, have now participated in transformational M&A already in this cycle. Now, here's the part that often gets overlooked. M&A doesn't just affect the bank that gets bought. When Comerica sells initially at 1.7 tangible book last year, and Webster sells closer to 2 times, the market starts to ask a very simple question. If that bank is worth 1.7 or 2 times book, what's the next one worth? It's not complicated in terms of the psychology here. Investors look across the remaining independent regionals and start to benchmark them against takeout values. And over time, that tends to pull valuations higher for the entire peer group, even for banks that aren't transacting. That's sort of the gravity effect of M&A. Now, alongside all this, there's been a narrative forming that activists are driving consolidation in regional banks. But if you look at the facts so far this cycle, roughly 7 large regional banks have participated in transformational deals, and only one of them had an activist investor involved. The most recent one, Webster, did not. So to us, that reinforces the point we've been making all along. Activists are making some important points here, but they are along for the ride from an M&A standpoint. They are not driving outcomes. This wave of M&A at the regional bank level is being driven by structural considerations that we've talked about: regulatory openness, scarcity, strategic necessity. And that distinction, I think, matters, because if consolidation is structurally driven, it has more durability, right? If it were activist driven, it would be more episodic to the names that the activists are involved in. Now, having said that, no investment theme should ever really be treated, we think, as a bet the ranch assumption. If your mandate is more NA-centric around activism and you're concentrated in underperforming institutions on the premise that you can influence a sale, your risk profile looks different. In a benign environment, that works really well, right? But in a downturn scenario, underperformers tend to underperform for a reason. And if that M&A window narrows temporarily or otherwise, the ability to be flexible from a portfolio management standpoint matters. That's not our base case from a macro standpoint. If it were, we wouldn't have owned names in the fund like Comerica or Webster. But as investors, we believe you want to participate in the structural M&A tailwind while still maintaining that balance in case the macro environment shifts or just in case you're flat out wrong with your thesis. But again, our base case is for a robust M&A environment, and we are participating in that. And that brings us to the next topic, private credit, which is something we're watching closely, not because we think it derails the M&A cycle or the bullish thesis on banks, but because it informs overall risk. So let's shift to private credit. There are really, I think, two conversations happening right now. One is around direct exposure. So particularly private credit exposure, BDC exposure to software businesses and potential AI related disruption. There's a high level exposure from these lenders to that segment. That's real. But what has raised our antenna more recently goes beyond sector exposure. So last fall, when Tricolor, First Brands ran into trouble, the subprime auto companies that went out of business basically or had problems, several banks had exposure. We said at the time that those situations didn't appear to represent broader pervasive credit issues for banks. And we also said that the sell-off in bank stocks through the early fall was driven just as much by funding market stress behind the scenes as by those apparent one-off credit events. So what's changed right now is we have some additional information, right? This situation involving MFS, Market Financial Solutions is the name of the company. It's in London, where public reporting has raised questions about collateral structure, including potential double pledging of assets. And that's very similar to the reporting that we saw around the collapse of those two companies last fall. So again, could be just another one-off. But when you see multiple instances over time where the discussion centers not just on credit losses, but on collateral transparency, layered financing structures, it's reasonable, I think, at that point to step back and ask whether there are common structural features that are worth taking a closer look at. And it highlights something, within private credit that we've been watching closely for a while now. So let's take a step back for a minute and put this into context. So banks historically did a lot of this type of lending that's sort of known as private credit today. After '08, Dodd-Frank, was a statute in 2010. Other regulations around the banking industry tightened the screws on banks and pushed a lot of this stuff, this type of lending, outside of the regulated banking system. And a lot of it found a home in areas of private credit and private equity structures, right? And we've seen this migration dynamic before, where this type of lending morphs into something else after it gets into a trouble. But it's essentially the same thing. In the 80s, it was leveraged buyouts financed by junk bonds. That all ended with the Drexel-Burnham collapse. Then it morphed into, the same type of concept morphed in the early 2000s into subprime mortgage lending. And that obviously blew up the financial system. The banks took it on the chin. The banks were at the core of what was going on there. And then it shifted again after the '08 collapse, this time into private credit, that type of lending. And for more than a decade, through a period of really explosive growth, the backdrop for that type of lending was extremely supportive. So you had very, very low rates, stimulus like we've never seen before, first after '08, and then especially after the pandemic. You had easy access to capital. You had limited regulatory oversight of this type of lending compared to banks. And in that environment, with those kind of tailwinds, almost any credit model can look pretty good, right? And the pitch was pretty simple and pretty effective. We can move faster than the banks. We can be more flexible. We can customize structure to the customer. We can charge a higher rate. We can lock up capital long term. No bank regulatory exams. You mark your own portfolio. You have fees based on reported NAV. And in some cases, banks will lend to you, to these private credit firms, against those NAVs. So when asset values are stable or going higher, and the system is sort of awash in liquidity, that structure functions pretty well. It's extraordinarily profitable, but things can change, and they have changed. So when public reporting begins to raise questions about collateral layering, or when publicly traded vehicles trade at steep and persistent discounts to reported NAV, which is what we're seeing right now with some of these listed private equity, private credit structures, it suggests that market confidence in valuation marks is shifting, right? That doesn't automatically mean the marks are wrong, but it does mean perception of risk is changing. And that, it sort of brings me back to over 20 years ago, a quick story, 2005 to be specific. So I was a sell-side analyst covering banks. I brought a group of investors in to meet with Bob Wilmers, who was the CEO of M&T. M&T was the first larger size regional bank stock I was assigned to cover as a younger analyst. And of course, Wilmers was a legend in banking, probably the most well-respected banker of his generation. Someone in that meeting asked him in 2005 what kept him up at night. And he was famous for like his short answers without really much explanation behind it. And he said, without any explanation really, he just said negative amortization lending was his concern. This was 2005. So housing data looked fine, credit looked fine, home prices were going up and up, no obvious cracks yet. Someone asked him why that worried him. Because he really didn't offer, as I said, any explanation. He didn't make a prediction. He didn't talk about what could happen in various recession scenarios or all this type of analysis with data behind it. He just said the whole thing doesn't make sense. And if you think about the structure of what negative amortization lending was, the structure allowed borrowers to make monthly payments that didn't even meet the monthly interest that was due on the mortgage in many cases. So your loan balance would grow over time. Obviously the opposite of paying down your mortgage with your monthly payments over time. And the theory that this rested on, which seems ridiculous today, is that home prices would rise at a faster rate than the mortgage debt would. So if there was a problem ever for the borrower, they could just go sell their home and easily satisfy the debt, right? Because your home value would be in the future worth a heck of a lot more than what you owed. So his point wasn't about timing or what could happen or what could go. It was about the structure, the underlying business model itself of this type of lending. He thought the design itself created a vulnerability in any kind of stress scenario, and he didn't really pay any mind to. There was no data that he cited really at all to back him up on that at the time when he made the comment, and really because there really wasn't any to disprove to say he was wrong. And I never forgot that, especially after what happened just 3 years later in 2008. When this type of lending was at the center of what collapsed the financial system. And so when I look at certain segments of private credit today, what gives us pause isn't one particular industry exposure. It's sort of the overall structure of how it works. So that doesn't mean there's an imminent event or if there is ever even a material event. But when similar structural questions arise more than once, and you start to think about the broader macro backdrop and how it's changed, and how those macro conditions fueled the growth of that asset class, you start to wonder how those structures would behave during anything but, when a tailwind is behind this business, which we are obviously not in today. So what does this mean for banks, for what we do? So first, any stress, we're encouraged by the fact that any stress that might develop here didn't originate within the regulated banking system. Banks have ceded a lot of market share in many of these lending categories over the past 10 to 15 years. In some cases, because they just aren't allowed to do it anymore, or they haven't been allowed to do it. So if you were to have a major problem here within private credit, private equity, banks aren't going to be at the epicenter in the way they were in 2008. And so I think that matters in a positive way. However, that's not to say that banks are completely insulated, not by any stretch here. Banks lend to these institutions. They provide, and it's larger banks that lend to these institutions primarily. They provide lines of credit to funds. In some cases, they provide financing secured by fund assets or reported NAV. We've heard bank management teams about how their exposure to these areas historically experience very minimal losses, right? All true. But long periods without losses also goes hand in hand with tighter spreads, which increases risk, right? If you were to have a problem in these areas that historically have not had losses, because there's just no cushion from a lending standpoint. And banks are obviously credit sensitive just generally. So no matter where within or outside the system you see credit stress, the reaction with respect to the stocks is to shoot first and ask questions later. So you have seen and you will definitely see spillover in the banking system through these relationships, and just from the fact that banks are also just risk assets. And it's not going to matter, especially early on, if the bank sector isn't the source of the stress. So that's the framework we're using as we think about risk. And there are ways to kind of protect from against that from a portfolio management standpoint, et cetera. I'm not going to go into all that. But now, bottom line is we talk to a lot of banks all the time. And the good news is we're not hearing about credit stress on bank balance sheets. We just aren't. And if it does turn out to be a major problem emanating from some other segment of the market like private credit, it's going to be painful for banks in the short run and bank stocks, but it's also going to represent a tremendous longer term opportunity, as banks would presumably then have an opportunity. A lot of these private credit vehicles and private equity structures do not have credit workout capabilities. And I don't think they're going to have the patience for those types of credit workouts if this were to spiral. This is what the banks do, right? So if it were to spiral, the banks are sort of the mechanism by which this stuff gets worked out, and presumably will have an opportunity over time to reclaim some of this lost market share that they've lost over the past decade. So we zoomed in on this topic. Now let's zoom out to close here. If you look strictly at bank fundamentals right now, they're still extraordinarily very, very solid. Earnings have been strong, very strong. Funding markets are functioning well now relative to last fall. QT has flipped to this form of QE light, which is a big, big deal. We've talked about that. Capital levels are strong. The operating backdrop for this sector right now is still really compelling. So we have two realities here at once: strong fundamentals and attractive valuations, and then a segment of the broader credit market that bears closer scrutiny that has the potential to spill over into this area. So our base case remains bullish for the banking center as a whole. And we're going to have to, we have been, and we will continue to monitor these issues as things continue to develop. And with that, we'll leave it there. We'll talk to you soon. Thanks again for listening today.